So I think you are on the right track, Paul, because I think what you're talking about is you might see that there are a lot of market buyers coming into the market and a trend is forming. And so you decide to buy too. And by the time you're sure enough to get into the market, and you get in, the trend immediately stops and then just collapses on top of you. How do you deal with that? Well, let me back up a second and talk about what is the inelastic market and the practical consequences of that to make sure that we're all on the same page first. So elasticity is really a measure of how supply and demand will react to a change in price. So for instance, if the price goes up in a very elastic market, then the demand for that good will decline, and that will kind of like pull the price back down. So it's kind of like you have a rubber band between your fingers, and if you pull your fingers apart, the rubber band brings them back together, right? Well, what would be the opposite of that? What would be an inelastic market? Well, that would be like you pull your fingers apart and the rubber band just stretches. That's an inelastic market. So the measures that we get from studies suggests that if you take $1 out of the bond market and put it into the stock market, that it increases the total market cap of the stock market by $5 to $8. So the price really, really responds strongly to those new orders coming in. And this has some consequences both on high time frames and short time frames. On high time frames, this could potentially explain why strategies like momentum strategies, and this is where you're taking technical signals and you're holding things for several months and managing the risk of an overall portfolio, that might explain why those kinds of strategies work. But on a short-term basis, it also kind of explains why the market can just be so confusing. That because markets react so strongly to price and liquidity conditions differ, prices just has a lot of noise in it. So the first thing is that if you're doing an analysis, you're going to get a cleaner data set that you can derive information from by looking at the orders themselves. But even with just looking at the orders, you can't really use past data to predict future data on short time frames very well. So the real issue is you can't follow. You have to know that that flow is going to come before it happens. So when I'm looking at the order flow, it's really more of a confirmation. I already have an idea based on the news and the time of the month and seasonality what's going to happen, and the order flow is just confirming that I'm right.